Hello, fellow Rebel Capitals. Hope you're well. So we've got bond yields exploding higher. Well, not really, but if you listen to the mainstream media and FinTwit, this is exactly what you would think. And the narrative around this is all wrong. They're talking about how this is a huge red flag. This is a massive warning that the bond market is fighting Trump and the bond vigilantes are back. There's no more demand for U.S. treasuries, and therefore the interest rates at the long of the curve are going to go higher and higher and higher and higher. And then the Fed is going to have no choice but to do yield curve control and more quantitative easing, just like the Bank of Japan. Now, maybe they'll do quantitative easing. I don't know. But I can assure you they don't have to regarding interest rates. So let's go over what the market is saying, this big narrative and this huge warning, this big red flag they're talking about. It really revolves around the fact the 10-year Treasury got up above, for a moment, 4.5% today. So this is the big brouhaha. So let's go into Twitter. I mean, the Kobisi, I don't know how you pronounce this, but they've got some good stuff, but they're kind of parroting this line here. The bond market is fighting Trump. Oh my gosh, it's fighting Trump because Trump wants interest rates to go down, and the interest rates are going up. So, oh my gosh, what's going to happen here? So the premise with this narrative is in order for the economy to grow, we need lower interest rates. And somehow, because interest rates aren't going down, that's preventing the economy from growing. This is so backwards. And I don't want to single out the Kobisi letter because they got a lot of great stuff. And this is like 99% of FinTwit has this view. They're all backwards, right? So it's not just them. What do they have wrong? Yields, especially at the long end of the curve, are about growth and inflation expectations. So you don't have low interest rates and high growth. That's not a thing. It's not a thing. If you want higher growth, which is obviously what Donald Trump wants, you don't need lower interest rates. In fact, if you're getting that growth you want, interest rates are going to be higher. They're not going to be lower. This is total nonsense. And the fact that it's repeated so often on FinTwit and in the financial media, CNBC, Bloomberg, Financial Times, etc. And it kind of coincides with this view that the Fed is losing the long end of the curve. Like they're losing control of interest rates. There's just no more demand. And obviously there's no demand because we're running these massive deficits and we're putting so much supply into the market, and China's dumping our treasuries, blah, 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 this dumping their treasury. So then there's just no demand for treasury. This is what you hear over and over and over and over and over again, that the reason why interest rates are at 4.5 is because there's just no demand. There's no demand for treasuries. This is a big problem. This is why we have to get the deficits down. And yada, 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 yada. We got to get the deficits down, absolutely. But not because there's no demand for treasuries. So let's first tackle the no demand for treasury nonsense. And then we'll get into this growth and how the bond market is fighting Trump, as if Trump, and it's Trump's own fault because he pushes this narrative, right? He pushes the narrative that in order to really turbocharge the United States economy, we got to have low interest rates. I can assure you, if we have low interest rates, the U.S. economy ain't going anywhere. Because Trump, Bessent, Powell, I don't care who they are, they don't control interest rates along the curve. Growth and inflation does. So if you get lower interest rates, you're going to have lower growth. That's why the interest rates go down. And if you want higher growth, then you're going to get higher interest rates. That's just the way these things work. It is what it is. I'm going to go into the charts and back this up, of course, with historical data. But first thing here, Okay, there's no demand. So let's go into, actually, let me do this in reverse order. Let me, well, now actually, we're going to do it the way that I thought here. So let's go into, let's see if I got a chart of Fed funds. We do 3 month. That's close enough. So we've got 3 month versus the 10-year. Okay, so look at where it is right now. We're barely positive. And the 10 years maybe, I don't know, 15 basis points above Fed funds. So this chart would look very similar. In fact, let's not just guess here. Let's go right to the source. So FFR versus 10-year. So here we go. So you can see that it's pretty much flat, but if we zoom out, look at this. I mean, who are we trying to kid here? It's amazing to me that all the people that say that the bond vigilantes are back, there's no demand for treasuries. Have you looked at a chart lately? Like, all you have to do, and what blows my mind is that all these people are coming to the conclusion that there's no demand for treasuries, and they completely ignore the treasury market itself. Like, oh, that treasury market thing and the price signal that I'm getting from the buyers and the sellers and the treasury market, that doesn't matter. That doesn't matter. There's no demand for treasuries. It's just, it's like seeing a chart of Nvidia today that went up by like 6% and saying that there's no demand for Nvidia shares. What? The price has gone, or over the last 2 weeks. What are you talking about? Look at the damn chart, right? So what I'm saying here is, sure, interest rates have gone up, but the fact of the matter is they're barely above Fed funds. Look at this. Look at the spread that we usually have between the Fed funds rate and the 10-year treasury yield. I mean, look, let's kind of eyeball an average right around here. That would be, call it above 1.5%. So 150 basis points. So usually the spread, meaning that the 10-year is about 150 basis points higher than Fed funds. So right now they're about flat. And you're telling me there's no demand for treasuries. Look, if there's no demand for treasuries, the treasury curve isn't going to be flat. By definition, if the treasury curve is flat or inverted, that means there's massive demand for treasuries. Not no demand. Like what are we talking about here? This is Zoolander. This is Mugatu, just thinking that he's taking crazy pills. Every single time I hear this narrative, that's the way I feel. I feel like I'm taking crazy pills. So again, if there was no demand for treasury, you would not have a flat curve. Don't take my word on it. Just ask the damn treasury market where there's actual buyers and sellers. Ask them what the demand is. The price tells you everything you need to know. Okay, so now let's go ahead and answer the question. How would I know there is a lack of demand? Like what would give me that signal, right? So what we have to do is we have to look at nominal GDP. So now let's go over to this next chart. Because if it is true, which it is, that the long end of the curve is about growth and inflation expectations, if that somehow decouples, then that would then the 10-year treasury would decouple from nominal GDP. Right? So now let's go look at this chart going back to, let's say, this goes back to 1950, but let's look at 1960. Right? Do you notice anything about the trend with this chart from 1960 to, call it, 1978? We're going from a low of, I call it 1%, and going higher and higher and higher. The trend is higher until we peak out at about 15%. What is this? This is nominal GDP. Nominal GDP. Okay, now let's go ahead and look at a chart of the 10-year Treasury during the same time frame. So we go to, call it 1960-ish, early 1960s, and what this chart is obviously compressed, but what does it do? It does literally the exact same thing. It follows nominal GDP. Even in the 1970s, it's following nominal GDP, where it peaks out at roughly 15%. And what did nominal GDP peak out at? That would be 15%. Now, not that it's always completely tight at the hip, but if you look at long periods of time, it is obvious how the 10-year Treasury is just growth and inflation expectations. And what is nominal GDP? It's growth and inflation. That's all it is. It's literally the formula. You got inflation, real GDP plus inflation. That's nominal GDP. Growth and inflation expectations. Okay, so now let's go ahead and see what the 10-year Treasury, well, you guys know this, but what did the 10-year Treasury do from 81 straight down to 2020? Well, it went straight down. Okay, so if it is true that the 10-year Treasury yield follows nominal GDP growth and inflation expectations, then you would expect nominal GDP in the United States to have done the exact same thing. So we look at this chart, and again, this is spread out, but if you look at the trend, 15 going down to, call it 3.5. In other words, the exact same. A decrease of 12% nominal GDP, and we had a decrease of the 10-year Treasury of a little more than that, call it 13%, maybe 14%. You see where I'm going with this, guys? The long end of the curve is all about growth and inflation. So you say, okay, when will we know that is decoupled? That's easy, very easy. When the 10-year Treasury yield is trading substantially higher than nominal GDP for a period of time of, let's say, 2-3 years, then you know that we got a demand problem. Then you know we got a demand problem. And now all of a sudden, the bond vigilantes are, and by the way, this nonsense of bond vigilantes, where did this even come from? Like, show me, here's nominal GDP. Here's a 10-year. Show me the bond vigilantes. Bond vigilant, what are we talking about here? In the 1970s, the bond vigilantes? No. The 10-year Treasury was just trading with growth and inflation expectations. There were no bond vigilantes. Just like today. And by the way, if you look at what the 10-year Treasury yield has done since the Cerveza sickness, it's gone straight up. Well, what do you think nominal GDP has done? Oh, wow, it went straight up. And then it came right, then it's come back down. And if we zoom in to the last year, now this doesn't include the first quarter of 2025 that was highly skewed and nuanced due to the imports, et cetera. You guys know the story. But for the last quarter of 2024, nominal GDP was right around 5%. Okay, so where was the 10-year Treasury yield? It was lower than that. So not only currently is the 10-year Treasury yield not at nominal GDP, it's lower than nominal GDP. And you're telling me there's no demand. And you're telling me the bond vigilantes are back. This is madness. This is madness. And it's like, I don't know if it's cognitive dissonance. I don't know if it's just people are so religiously tied to a narrative that it just clouds their thinking, or it it prevents them from just intellectual honesty, or it prevents them from even looking at a damn chart, for heaven's sakes. Because that's the only way that you could come to these conclusions, that there's no demand for 10-year treasuries. It's completely absurd. And by the way, it's not just random people on FinTwit. I was listening to Richard Fisher today, former, I believe he's the head of the Dallas Fed, on CNBC. He's parroting the exact same nonsense. That we have a supply issue. What? What are you? So again, when will we know that there is a demand problem? Well, again, that's easy. When you see nominal GDP at 5% and you see the 10-year treasury trading at 10%, now you got a demand problem. Now you got a problem. But if you see, and I know that nominal GDP came down to 2.4, but again, we got to look at over longer periods of time. You can't just take it by a quarter. And also that quarter, I'm not saying that it would have been a lot better without the imports, but there was a lot of nuance in there, right? But the point is, there is, especially if the 10-year treasury is trading under nominal GDP, which it was in the fourth quarter of 2024, and you've got a curve that's basically flat, that tells you that there's excessive demand. The Fed is not losing the long end of the curve, for heaven's sakes. It's the only reason that the 10-year treasury yield, let's see if I can get another chart here. The only reason the 10-year treasury yield is trading right around 4.5%, let me zoom out, is because Trump kind of did a trade deal, and we get growth expectations increasing. Yields go up. There's no bond vigilantes or anything like that. It's just simple. Okay, no more 140% tariff on China. Okay, well, that's probably pretty good for the U.S. economy. Now, I'm not saying it is. I'm saying this is the market perception. And you can tell that by the stock market ripping higher. And what would you expect along it? You'd expect it to go up slightly. It was exactly what it did. Again, why? Because of growth expectations. And it's sure not inflation expectations, because we had the CPI coming at 2.3% today. So this dovetails perfectly into the next kind of red flag that everyone's talking about here. And that's going back to this tweet, this idea that somehow the bond market is fighting with Trump. And Trump is trying to create higher growth. Therefore, he needs lower interest rates. This, again, is completely backwards. So let me restate this. If interest rates go down, Trump is not going to get growth, because the reason interest rates are going down is because growth and inflation expectations are decreasing. Now, if Trump wants the economy to grow, which I'm sure he does, then you want higher interest rates, because that's a reflection of growth. You don't get you don't get low growth and or low, you don't get recession and super high interest rates, or interest rates going higher and higher and higher. And you don't get an economic boom with interest rates at 0%. That's not how it works. It's the complete opposite of that. And if you want, again, all we have to do is go back and look at the chart of GDP growth, and you show me, you show me, like right here, okay, we had extremely low growth, right? And we had 0% interest rates. Okay, well, in other words, especially in real terms, we had low growth, right? But even nominal terms, relatively speaking, during this time frame, we had low growth and we had low interest rates. That's the way it works. And here we had very high growth, nominal, and we had very high interest rates. There is no time when you have high growth and high, or when you have high growth and low interest rates. It's so anyway, you get what I'm saying, right? I get frustrated with this stuff because it's, if you just look at a damn chart and look at history, and just use some simple common sense, right? So again, if I'm Trump, I don't want lower interest rates, because lower interest rates means that the economy's shrinking, that I'm doing a bad job. If interest rates are going up, I'm like, all right, that's fantastic. We got the animal spirits here, and the economy maybe is resilient and strong, and maybe the economy is going to continue to grow. That's what the interest rates are telling me. You can't manhandle the interest rates down, and just it's like what kind of visual would I? It's like a beach ball trying to hold it under the water. You can't do that, because sooner or later it's going to pop back up, right? And that's what interest rates are going to do if the economy is growing. So what a lot of the people that I'm hearing, they're like, oh, well, in order to get this growth, we need lower interest rates. And again, I know I'm beating a dead horse here, but this is so common. And I see it over and over and over again everywhere, that if you want higher growth, you want to see interest rates going higher. Because if interest rates are going lower, I can assure you, you're not getting higher growth. You're getting lower growth. Now, you could say, okay, George, well, he wants interest rates down, not really about the growth or the recession, but more so because he wants to reduce the deficit. You see, and we've got 10, 12, whatever trillion dollars that we have to roll over this year. So he's got to get interest rates down, or else the deficits are going to explode. That's the other just insane narrative you hear. Why is that insane? Because let's look at a chart of the actual budget deficit. Now, you'll notice these shaded areas are recessions. And what happens to the deficit when the U.S. economy goes into a recession? Does it improve? What happens, in other words, what happens to the deficit when growth and inflation goes down, when the economy contracts? The deficits explode higher. Explode higher. And then when you go into a recovery and the economy starts growing again, even if it's slow, it starts growing again, then what happens to the deficit? Then it goes back up. Now, it's true, this is trending down. That's for sure. But I can promise you that if we are not in recession right now and the deficit's at 6%, if we go into a recession to try just to get interest rates down so we can lower the deficit ain't going to go lower. I don't care if you got negative 3% interest rates. The deficit is going to explode. And you say, oh, no, George, because Trump, oh, he's got religion. He's not going to do stimmy checks. He's not going to do any fiscal. He's just going to let the economy contract. Okay, that's fine. Even if he doesn't do fiscal, what do you think is going to happen to tax receipts? Pew! Tax receipts are going to plummet because, of course they are. What do you think tax receipts are going to do in a recession? You think they're going to go up? Of course not. They're going to, especially if you have asset prices going down. So even if he doesn't do all this fiscal like he did last time, even if he doesn't do any of that stuff, you're still likely going to see the deficit explode because tax receipts are going to plummet. So this idea that we have to cause a recession or create lower economic growth in order to get interest rates down so we can roll over the debt at lower interest rates so the deficit doesn't explode. This is complete crazy talk. This is not grounded in reality. This is a level of mental gymnastics that I don't think I've ever seen before. So I get so frustrated with this stuff. I really do. I really do. So the main takeaway here is that are yields giving us a warning? Yes, in fact, they are absolutely giving us a warning. But the warning is not that the bond vigilantes are here. The warning isn't that the bond market is fighting Trump. The warning isn't that there's no demand for treasuries. The warning is that there's massive demand for treasuries. That's the warning. And that the yield curve is flat. And the yield curve was inverted. And what that the warning that that's giving you is that there's too much demand for treasuries. And the fact that there's too much demand for treasuries tells you what huge banks and financial institutions are doing with their balance sheet. And that's they're buying the safest and most liquid asset and putting that onto the balance sheet instead of taking that balance sheet expansion and using that to lend out into the real economy. Why are they doing that? Because they're scared of the risk involved. There's too much risk. And therefore, expanding that balance sheet to lend out to the real economy, the reward doesn't make sense. It's risk reward. So what they're doing, because they're risk off, I don't care what the retail investors are doing in the stock market, the bottom line is they are risk off because they see economic storm clouds. Therefore, they're buying the long end of the curve. Therefore, the curve is flat, or more recently, it was inverted. So that's the red flag here. That's the warning from the bond market, is that there's too much demand for treasuries. And that means that the growth in inflation expectations, or the probability, let's say, of an economic contraction are higher than they would be if there was less demand for treasuries at the long end of the curve. All right, guys. So now the question becomes, what do you do about it? Now that you have a better understanding and you're not one of these lemmings in the mainstream media that just parrots this nonsense without even thinking about it, what do you do about it? How do you set up your portfolio? I'm glad you asked. That's what I'm going to be discussing in Rebel Capitalist Pro Friday morning. We're going to do a webinar in there at 11 a.m. Eastern time. And I've made some big changes to my personal portfolio that I have in there. I've got one portfolio with 100,000 in it, another with 300,000. And so I've made some big changes recently with this portfolio based on what I think the market just completely misinterpreting what's going on. So if you want to participate in that, just go to georgegamma.com/pro. You can sign up. You can do a $1 trial. And if you're not there live, if you can't make it, that's fine. You'll have access to the replay on the homepage of the Rebel Capitalist Pro forum. So this is something you're definitely going to want to check out. I'm going to dive into the nuance. I'm going to go over charts. I'm going to go over my own personal portfolio, pull that up for you guys. And hopefully, it's not investing advice, but hopefully you guys can use that as takeaways to make better decisions about your own portfolio and investment strategy moving forward. So again, if you want to participate in that, you can go to georgegamma.com/pro. All right, guys, enjoy the rest of your afternoon. As always, make sure you are standing up for freedom, liberty, free market, capitalism. We'll see you in the next video.